Welcome back, everyone. Just an action-packed afternoon of content. Thank you for that, Jason. That was fantastic.
Absolutely. Went by fast.
Oh my God.
I bet the
Great,
days blowing by fast.
great content, Melanie. Thank you so much. So Shannon, we've turned a corner. We're on the home stretch. I see the PowerPoints in between programs. So anybody who wants to sign up for collaborative practice training, that's starting in October. And we'll put an extra link into the box. Still 10% discount code if you sign up this week. Still hovering just under $10,000 for Denise House. So, I feel very honored to be part of the legal profession, and it's a privilege. And I think we all have a duty to give back to the communities that we serve in. Feel free to cut and paste the GoFundMe link and share it on your social networks. But help us get over the top. We're going to hit 10,000, I predict, by mid-afternoon. We're pretty close, right, Shannon?
Yes, we are very close. So thank you again to all of our attendees who have donated, all of our speakers who are donating their time and their knowledge, and we're so grateful for that. We wouldn't be able to do it without all of our speakers. So I also want to give them a big shout out and a big thank you. And yeah, we still have a few hours to go. It's hard to believe we're just down to our last couple presentations, but it's nice to have you both back, Jason and Melanie. We appreciate you and all your time today. Melanie and Jason are going to be speaking about attribution of pre-tax corporate income. I won't spend time on introductions as we've already met, and I want to give Melanie and Jason as much time as they can to cover this content, but I will just give you a snapshot of what you can expect for the next presentation. So Melanie and Jason will be discussing income assessment for business owners, Section 18 of the guidelines, nature of the company, historical practice, ability of the spouse to control the distribution of funds, amount of income available having considerations for the financial status of the corporation, and lastly, other income issues. And similar to the last presentation, please feel free to send in any Q&A you have through the Q&A, and we'll do our best to get to as many questions as we can. And on that note, Russ, anything else you'd like to add before we pass things over to Melanie and Jason? Oh, you're muted.
Run that poll number one. We've got lots of questions that have come in advance, so we've got a lot to cover. So let's make a start. First poll question is, what experience do you have with income assessments? We'll give everybody a few minutes to answer that, but let's go. Jason, I'm going to start with you. What if the business has net pre-tax losses in the year? Does that get deducted from the spouse's income for support? Just come out swinging, right?
Yeah, yeah, exactly.
No
exactly. No, that's a good question. And, the guidelines talk about pre-tax income. They don't talk about pre-tax losses. So if you take it at face value, then I would say no, but I don't really know because I have seen expert reports that do include losses. I tend not to. I typically don't, and I think most evaluators don't. They interpret the guidelines that way, but I don't know. Melanie, what do you think?
Yeah, it's an interesting one because it's certainly not clear. And I remember sitting in a judge's chamber after a case, and the judge basically said, well, if you read it literally, that's what this says, but agreed it wasn't fair. So I think you get into challenges. I think some experts, and sometimes we do this too, will do two scenarios. If you think this is appropriate to deduct losses, here you go. And it also crosses into the issue of capital preservation. So I think my answer generally is, let's do two scenarios.
I'm not going to pretend to know what I'm talking about. You guys are way above my pay scale. That's why we bring you in to help us out with these things. So let's see what our audience is saying here. Attribution, what experience do you have with income assessments? No experience, 32%. Majority of our audience is lawyers today. Some experience 49%, great experience 18%. Well, hopefully the great ones will get something out of this as well. What is an income set? Well, everybody knows what it is according to this poll, and other, you can put that in the Q&A. So Melanie,
Yes.
can a CVV help-
Equivalent concept.
Sorry, Jason, you just cut off. You want to start off from the beginning?
Oh, can you hear me now?
Yeah, you're great. So let's go back to where we were. Income assessment for business owners. What do we need to know?
Oh,
I can hear you now.
Okay, good. So this is a good place to start. Sorry we cut off, but this,
No worries. I was just going to pepper Melanie with the tough ones, so you saved her.
good.
Thank you.
So this topic provides the context for today's sort of topic, right? What is an income assessment? Income is needed for support purposes, right? And income for support purposes is calculated in accordance with the federal child support guidelines. And under those guidelines, income for support purposes is a gross employment income equivalent concept, right? So for business owners, what does that mean? Well, for business owners, what that means is the benefits from business ownership must be included in one's income for support purposes. Now, in sort of the general process for an income assessment for determining one's income is to start with the individual's tax return and what income was reported to CRA. But then a number of adjustments have to be made in accordance with the guidelines. And one of the adjustments that have to be made when there's a business owner is potentially the attribution of pre-tax corporate income. So that's what we're talking about today. Today, specifically, we're drilling down on that one adjustment to income assessments for business owners. Any other thoughts, Melanie, on?
No, that's exactly it. I mean, there's a lot of different components that go into the calculation of income for support purposes. Some of them more judgmental than others, but definitely this one we're talking about today, the attribution of pre-tax corporate income, is certainly one of the more subjective ones.
All right, great introduction. Let's go to our next poll, see what our audience is thinking. And we had a great question come in, which I'm going to get to. So in your experience, how long does it typically take for an income assessment to be completed? And let's go to this audience question that just came in. Please send us your questions. They're fantastic. We really appreciate it. When a corporation does not have enough money to distribute its earnings in a given year, but then has enough cash to catch up in a subsequent year, how is that dealt with? Sounds like a law school exam question, really, but that's a great question.
Yeah, or it could be, so one of the things that happens with this issue of attribution pre-tax corporate income is we start by looking at, as accountants, we look at financial statements. And financial statements are prepared on a certain basis that may not be cash, right? So a company may be growing and building up the sales may be high, the profits may be reasonable. It may all be going into inventory or receivables, but there's just not cash there to pay out to somebody. So even if the payer said, I'd love to take out more money, put on my tax return and pay you more support, but this company can't afford it. Otherwise, I have to go to the bank and they may not lend to me, or it may not be, I don't want to pay interest or whatever it is. But so it doesn't have to be loss situations. It can be just normal operations that require some working capital to be maintained in the business.
Jason,
Yeah, that's a difficult question to answer in isolation, because you're isolating the cash balance this year and then there's more cash next year. I mean, when you're looking at this issue, as we'll talk about later, there's a number of different factors you have to consider, right? It's not just cash. It's, well, maybe they generated income, they had the cash, but they loaned it to a related company. So it's sitting there as a receivable. Like, I mean, there's a number of different factors. So, and also sometimes we do an income assessment for 1 year and we're just looking at 1 year in isolation, but other times we're asked to look at 3 years or 4 years or 5 years. And in those situations, it might make more sense to look at sort of the accumulation over the years and what's sort of going up and down in the business. So those are some initial thoughts I had.
Yeah, I was thinking you might take a 3-year average, right, and roll it out, and you're going to see probably some rollover from year to year. That would be catching up. So let's see what our audience is thinking. Same day, yeah, that would be something, eh? Put
It
a,
would be.
put a drive-through window in your office, and then you could just drop in and, give
That's
you the banker box of
that's right.
paperwork with the coffee stains on it, and come back in an hour.
Right.
Well, you got
One
24 hours to do the report, right? One day.
1 to 3 months, 60%. I think that might be quick. 3 months to 1 year, 26%. 1 to 2 years, 1%. Other 7%. I guess it would depend a lot on how timely the disclosure is, right? Like if you're waiting on a third-party accountant who has other clients, you're not going to get that information in 3-4 weeks.
Absolutely. Just like a business valuation and income assessment, we can do that as quickly as we are able to get the information we need.
Yeah.
And I guess one
Uh,
other thing to consider too, people usually want more current as possible, right? So they may say, oh, I want you to do 2024, but you have to be realistic that, 2024, it ends, yes, a few more months to go, but then by the time the accountants get all the documents together and get the tax return done and the financial statements, you may be many months out. So you have to kind of be realistic and think about the relevant period that needs to be looked at.
All right, let's go to our next poll. We're going to keep Shannon hopping in the background. So the next poll question is, what do you expect an income assessment to cost? So that's going to come up on the screen in a moment. Here we go. Thank you, Shannon. And while we're giving the audience a few moments for this one, I'm going to go to you, Melanie. Question about attribution. Can a CBV help develop a formula for attribution of PTCI in future years for a settlement agreement? Well, my first question is, what is PTCI?
Pre-tax corporate income.
Okay.
There you go. It's funny with acronyms. I was speaking to someone who talking about report writing, and they said one of the things with the report writing.
If I'm thinking of it, there's probably 200 other people probably thinking, what the hell does that mean? But maybe it's just me. So
no, that's
let's read it over again. Can a CBV help develop a formula for attribution of pre-tax corporate income in future years for a settlement agreement?
Yeah, I would say the general answer is yes, but I think it's a really challenging thing to do. Lots of people would prefer, in a simple situation, maybe you can, but if you've got a situation that it's a business that is not really stable, a business that, there's different shareholders, there's issues of personal expenses, there's a whole bunch of possible issues. It's very hard to say what's appropriate. So while it theoretically sounds like a great idea, let's put a formula into the separation agreement and be done with it. It will be a challenging thing to do.
Jason, what do you think?
Yeah, agreed. Like I mean, if we go through the exercise of doing an income assessment, then we do have a framework there, right? We do have a framework we can provide, but is that useful going forward? Like Melanie said, it depends. Is everything going to stay the same going forward, or are there going to be changes to the ownership, the transactions? Do they do a capital gain strip? Like any number of things could happen that it falls out of the formula. So it may be useful as a starting point, but you may still want to get someone to sort of check on the situation in subsequent years.
Would changes in the market condition affect the formula too? We went through COVID and a lot of businesses got turned upside down, or would the formula still apply?
Yeah, for sure. That could be another thing. And back to your point about averaging out the number of years, we often go to 3 years just because it's talked about. But if you were in the COVID years or just coming out, averaging may not have made any sense at that point.
You're averaging 3 out of 4 COVID years. It's not going to help you, right?
Right.
All right. You know what? We're not going to put depends in any more of these poll answers because this audience knows our trick now.
They know, they're smart.
$5,000, 13%, $10,000, 19%, $25,000, 8%, $100,000, 1%. It depends, 60%. It sounds like an auction we've got going on here. Yeah, it really does depend on, right, on the company, on the amount of paperwork. Sometimes there could be holding companies and multiple corporations,
Yeah.
multiple shareholders, public or privately held companies. A lot of factors come into play, I would imagine.
Yeah, absolutely.
So you guys are agreeing it depends?
Yes, they know. Your audience is smart, they know.
Yeah.
All right, Shannon, I don't know if you can do it. Take it all the depend answers, going for the next couple poll questions. I'm just joking. Don't do it if it's gonna freak you out. But Section 18, next subject, Section 18 of the guidelines. Yes, our favorite section. The court may determine the spouse's income to include all or part of pre-tax income of the corporation, referred to as attribution of pre-tax corporation, and factors typically considered by the court. So that's sort of exactly what we're drilling down in on this afternoon. I'm glad we didn't have this as part of a other program, because we really need an hour to talk about this. Melanie, you want to start us off?
Sure. So I guess the big picture reason, I think, why this is in there is it's very easy if you have a business, regardless of how large or small it is, to say, you know, I'll show $10,000 income on my tax return because I get to choose how much. I tell my accountant how much to do my T4, and I'm just going to leave everything else in the company. And it just builds. So it's that, you know, it's in a situation where someone controls what goes on in a company, it wouldn't be fair to say, ignore the company or ignore that corporate entity, because that person has the ability to have more support, more income. If they don't want to take it out as cash, fine. But
all of a sudden, I'm going through a divorce. Let's load up the company with retained earnings, right?
yeah, exactly. So I think
Sorry.
that's sorry. Yeah, that's the overriding consideration. So, you know, as valuators, and Jason can say if this was his experience, but I know when I first started doing income analyses, everyone at that time was attributing 100% of the pre-tax corporate income without question. And it's become a much more nuanced analysis now to say, hold on, that's really not fair to the support payer necessarily either, because if they did pull everything out to pay support, then that's going to harm the golden goose. So be careful. You know, you got to look at it from a business perspective, and that you want the business to continue to be able to support the family.
Yeah, it's not cut and dry. It's not cookie cutter. I mean, it's the court may determine, right? And it may determine to include all or part of the pre-tax income. So it's definitely not cut and dry and automatically 100%. And there are a number of factors that the courts typically consider when dealing with this issue. And, you know, nature of the company. What has been the historical practice? What is the ability of the spouse to control the distribution of funds? And the amount of income available for distribution. So here there may be income, but is it available for distribution? Those are different factors. And the fact that there's different factors just sort of tells you that it's a complex issue to deal with.
Yeah, and that's a great point. So I think the easiest analysis, and Jason can say if he agrees or not, but the starting point is, did the company realize an income, right? Often you just stop there. If they didn't, then okay, we're done. Okay, subject to this issue of attributing losses, but you're done. Then you've got all these other things to consider after that.
Yeah.
And I guess they may have covenants with their financial institutions, right? Like they may not be able to pay.
Mm-hmm.
That's right. Even on that fourth point, which is the income available for distribution? You know, I can think of 7 or 8 different factors to look at to assess that itself. So it's, a lot of different factors.
So what would some of those factors be?
We're going to drill down on it later on. Yeah.
All right. Got it. Okay. So let's talk about the nature of the company. You kind of touched upon that a little bit, Jason.
Yeah. So now what we thought we'd do is we drill down on each of these 4 factors to really get to the meat of each of these factors or issues. And the first one is, well, what is the nature of the company? If you're looking at a company and maybe it has income, you know, the first factor you look at is, well, what is the nature of the company? does the company require working capital for ongoing operations? Like it has to keep some funds in the business for its working capital. So what I look at is what is the working capital at the end of the period? And when I talk about working capital, I'm really just talking about, the company's current assets minus their current liabilities. Do they have the ability to pay off the liabilities that are coming due in the coming year? And to look at that, you can look at the history. Does the company historically keep working capital on hand? You can look at industry average working capital balances or current ratios. But working capital is one thing that depends on the nature of the company, right? Like if you have a holding company versus an operating company, a holding company is usually just an investment or real estate holding company, and typically doesn't require working capital. But an operating company could be manufacturing, it could be distribution. It's an operating company that manages receivables and payables and inventory. I mean, it has working capital that working capital needs, and it may have excess working capital or it may have a deficiency of its working capital. But that's the first thing in the nature of the company. The second thing with the nature of the company is how capital intensive is it? Is this a company that requires a lot of capital reinvestment for ongoing operations? Or is it one that maybe is just a service company and doesn't have a lot of capital assets aside from maybe some computers, hardware and software? So you can look to capital intensiveness. You can look to actual historical purchases. You can look at the capital asset cost base. You need to assess how much this company, given the type of company it is, needs to hold on hand for capital reinvestment. So I talked about the holding company versus operating company and the service company versus a manufacturing business. What if you've got a startup company versus a mature, stable business? A startup company may require higher working capital or capital reinvestment or capital expenditures during the growth or startup period. So you can really drill down on this one factor, the nature of the company. Any other thoughts, Melanie?
Yeah, a couple of things I add to that to watch for is this issue of conservative management. So when you get a private business, they're not necessarily responsible to board of directors that are saying, well, hold on, you've accumulated all this money, why don't you pay it out as dividends? So I often, I'll ask, one of the things I do when I'm trying to find out how much working capital is needed is ask management, so ask the owner, what do you typically need? And they'll say, well, we need at least 100,000 or 150. I go, why? Because you're collecting your receivables in 30 days, you're paying your trades in your suppliers in 30 days, you pay your employees 15. So yeah, you need a little bit of a buffer there, but you really don't. Why do you really need that much money? Oh, just because. So then you get into that issue with, yeah, that's what they've historically done, but do they really need to do it? Right. So that's one issue to look for. And especially in private companies where they don't have that, like a public company, you would assume, of course, that they're operating efficiently. The second thing to look at, as Jason was talking about, on the capital intensive nature. So yes, you would say, well, if I have I've got to replace all my computers next year, or I've got to buy a new printing press. That might automatically say, okay, we better keep all the cash here. But you can lease these things, you can borrow, so it's not the only option. I once had a case which I still laugh at, and there was a well-known expert on the other side, and what the reason was, and it wasn't Jason, the reason that they used for needing all this cash, like all of the cash for years, like we did a long term, was because the owner wanted to buy a building. So the owner had like $5-10 million accumulated over all these years, but wants to buy a building. So therefore it's not available for support, which to me was crazy, but they were trying to make the case on that capital requirements. So.
How'd it go?
I think it's still ongoing, but I keep shaking my head because there was various versions of that report, like various updates, and that still said the same thing. And after probably about 7 years of not buying a building, it was still, oh no, they still need the money because eventually they'll buy a building. But
Yeah, I think there's a lot of value to looking at historical practice prior to the data separation. You know, these divorce cases can take 3-4 years. So what was the practice before the business owner thought they're going to be on the hook for a significant support claim? And that's usually quite telling too, unless there's market conditions that are affecting that. Jason, what do you think about historic practice?
Uh, Melanie, I think was going to take this one, but I can comment.
Or no, sorry, you want to lead in? Sorry, go ahead,
Oh, that's
Melanie.
okay. Go ahead, Jason. I'll just add in.
Melanie, go. I'll get Jason next time.
Okay. So I think the history, Russell, as you said, it is very important to look at the history. And if they're always paying dividends and all of a sudden just around separation date, those dividends stop, then of course you're going to question why did they stop? There may be very valid reasons. The company may not have earned as much, the company may need the money to buy a building or not, but there just may be valid reasons. So and it's also good to look at the agreements. If you have a business that's more professionally run, they might have an agreement about how much they have to keep on hand at any point in time, or how they approve disbursements. So you want to go to those shareholders agreements and other things that say, or dividend policies. There may be a dividend policy in place. So yes, historical practice really important to consider.
Jason,
Yeah,
thought?
it's not a huge factor, but it is a factor that the courts look at. I mean, and what they're trying to get at is that if historically this business owner has been distributing out the income every year by way of dividends or bonus or whatever, yeah, I guess it's dividends, right? If the business owner has always been doing that, and then all of a sudden going through a separation, they change and keep it in the business, well then, what's the argument for it not being available for distribution and being part of your income, right? So I think they're trying to avoid that situation when they look at this factor.
And I guess the reverse is true too, to be fair to the business owner, right? Because they also want, I think sometimes the presumption is, as it should be, that they're running the business optimally, or were before the separation. So why would we go in and now say you've never taken dividends, but you should in theory be like, why aren't you? So you got to look at that side of it as well.
Yeah, I think that's a good point.
Ties in neatly with the question that came in. I'm going to throw this one to you, Jason. Well, if the company's built up retained earnings, is it appropriate to attribute all or part of the retained earnings?
Yeah, I get that question a lot, but that's not even the right question to ask, because a lot of times people hear retained earnings is the accumulation of income over the years, which is true, but that's not the exercise we're dealing with. Like, we're looking at, in a particular year, what was the pre-tax income of the corporation for that year, not the accumulation of all the historical income, just the income for that year. So that's what we're talking about. Is all of that available for distribution or not? And one of the factors that we look at to see potentially if it can be available for distribution is if there's retained earnings on hand, or retained earnings have been accumulated. That may be a factor to say that it is available for distribution. But retained earnings is not what we're looking at attributing. It's the income. So don't look at the balance sheet, look at the income statement.
Yeah, think of this on the separation. If you have a clean cut, those accumulated retained earnings in theory were already equalized, right? So you just want to look at what's coming after that, not what is already been accumulated, which is what Jason was saying. Just look at year by year what is accumulating or not.
Ties neatly into our next subject, the ability of the spouse to control the distribution of funds. Jason?
Yeah, this is the third factor, and this one is pretty straightforward. I mean, it just speaks to the ability to control, to make that decision, right? Because maybe the spouse only owns 25% of the shares, or less than 50%, a non-controlling share interest. They don't make that decision unilaterally. That has to be made in conjunction with other shareholders. So it can't be automatic that, oh, your 25% share of the income should be attributed to you. So having control and being able to make the decision is a big factor to consider.
Melanie, thoughts?
Yeah, I totally agree. And I think the other thing to look at is who are the other shareholders, right? So it if often comes up where people will say, well, hold on, this is for 25% shareholders of a family. Well, of course you should attribute 25%. Well, maybe not. If you separate the ownership from the running of the business, and if they need the money to run the business and not distribute it, then maybe it's not appropriate. But if all of a sudden, again, maybe back to they're all of a sudden changing their policy that they're now not distributing things, and they're using their group, their control together to change policies to protect the spouse that's separated, then obviously you'd have a different conclusion.
Sounds like you guys almost have to be detectives to get the nuances of the relationships and who's controlling what and what's really going on, right? Behind what it says on paper.
Yeah.
All right, amount of income available having consideration for the financial status of the corporation. Another factor, Melanie, we want to take a look at?
Yeah, sort of that's what we kind of talked about at the beginning that early on, is that often the first question is there income in that year? And if so, then go on to all these other considerations that Jason and I have talked about, and more sometimes. But it may be a little more nuanced than that, right? Because you may have to look at things like, well, again, starting with the income. If you read it literally, income is an accounting concept, right? It doesn't say cash generated, it says income. So, okay, let's go to the income statement or statement of P&L statement and start there. Okay, but is that number suppressed or too high because of accounting policies that may or may not reconcile with what you might think of more on a cash basis? So are we talking accounting income or cash? And of course, unusual, non-recurring stuff, should that be excluded or not? I mean, you might get into the issue of, is it go forward or retro analysis? Because if it's retro, you're looking, it is what it is in that year. But go forward, if it's a non-recurring, that's not, presumably that's not going to be there. So that might affect your go forward type of analysis. And I guess another really, really good thing, we talked about the dividends, is being careful not to double count. So if you get to the point of saying, there's 100,000 of gross dividends on this person's tax return, but the company generated 200,000. Well, you shouldn't be adding back 200,000 to the line 15,000, because then you're double counting that dividend. So you have to be careful of recognizing that there's things that may be on the tax return that you don't want to double count from the financial statements.
Yeah, I agree with all of that. Absolutely. I mean, the starting point is look at the pre-tax net income or pre-tax income on the income statement, but you may need to make adjustments to that before you even get to the point of assessing whether or not this amount is available for distribution, because you have to adjust for amortization and CapEx needs. You have to amortize or adjust for unrealized items, non-cash items, non-recurring items potentially. And then, like Melanie said, you've got an income, but if dividends were paid, you've got to back out that dividends because you don't want to double count. And so once you arrive at the amount that we're talking about as the adjusted pre-tax income to consider whether or not it's available, then there's a whole bunch of factors you have to look at to assess the availability. And I mean, I kind of go through this exercise of, first I'll look at the cash balance. Is there enough cash on hand? Then I'll look at the retained earnings balance. Is there enough retained earnings on hand? Then I'll look at the working capital. So now I'm drilling down a bit more on the balance sheet. Now I'm looking at current assets, current liabilities. And is there excess working capital there? Is there enough working capital for the business to operate? If there is, fine. There could be the income is available for distribution, but I sometimes look at industry averages. And if the industry average current ratio is 1.5 to 1, and my company only has a 1-to-1 ratio, maybe there's not excess working capital there. So once I look at that, then I look at, well, has there been any activity in the shareholder loan account? Has the shareholder taken money out of the business by way of a shareholder loan instead of income? Because if he or she has taken money out by way of a loan, then to me, that kind of indicates it looks like funds were available for distribution. You just chose to have it advanced to you by way of loan instead of paying yourself a salary or a dividend. So I look at that. And similarly, I look at loans to related parties, maybe not the shareholder, but related parties. And then I also look at the liabilities. Are there bank loans? Are there third-party debts? And are there covenants? Are there covenants that require a certain, tangible net worth to be on hand or current ratio to be on hand? And then after looking at all that, the final thing I look at, well, and what I often hear from the business owner is that, no, we need to keep funds on hand just to manage our risk, because our business is very cyclical and we can go up and we can go down, and we have a good year. That doesn't guarantee a good year in the next year. We could have a bad year. So we need to keep things on hand. Or maybe we're going through an expansion and we need to keep funds on hand for this CapEx expansion that we've committed to. Like, all of these factors have to be considered in assessing whether or not the income is available for distribution. I'm sure Melanie can add to that too. Like, it's not easy. It's not just cookie cutter.
No, great points. Great points. And the shareholder loan issue you brought up is a big one. And I'll give you an example. One of my challenges always is, if someone has let's say they have an interim order against them for support that's maybe too high over what they're earning. I've had clients who have had to pull out of their shareholder loan just to satisfy that order. But then we look at it, we go, oh, well, you're taking money out, therefore must be a lot to attribute. That may not actually be true. It may be just that they're trying to prevent going to jail and whatever else. They just want to make sure they meet their payments. So that, of course, for the lawyers, be very careful on the interim orders, but a big one for us to take a look at. One other comment I'll just make, and good points about looking through the income statement, and that we talked about reliability of financial statements sometimes being an issue. Just an example, I had a client who had prepared their own financial statements, and I looked at one particular year and there was a loss. So I originally said, well, maybe you stop there. But when I looked into the expenses, the business owner accrued like $2 million of warranty. I go, what, $2 million? Did you pay that out? No, I didn't pay it out, but just in case. And I'm going, no, let's look at what the actual obligation is, or how you calculated that. So being careful, you really need the valuator to help you out with that understanding of the income statements and balance sheets.
I can't make notes fast enough. I'm going to need to get a transcript of this. Do you guys have like a pre-flight checklist to remember to check all this stuff out? It's incredible. Great information. Yeah. Let's go back to our audience and engage with them and see what they're thinking here. Mm-hmm. What do you think the most contested assumptions are in an income assessment? We're going to leave that up for a few minutes. We've got some great questions coming in. Please keep them coming in. Question from one of my favorite colleagues out in Kingston. If a company is depreciating its machinery, how do you feel that this impacts on the argument that money is needed to be accumulated to replace equipment? Great question. What do you guys think?
Yeah, I think like in any capital intensive business with machinery and equipment, I mean, you purchase the machinery and equipment, you do depreciate it each year. So you see that depreciation on the income statement as reducing income. And when I start with my pre-tax income, I will add back that depreciation because that's a non-cash item. But at the same time, I will look at, well, what is the annual capital expenditures or reinvestment that this business requires? Because there could be a few periods where it's not that high, but machinery and equipment doesn't have an indefinite life, right? Like it may be around for 10, 15 years, but then you need to replace it. So what we want to try to do is try to smooth it out and look at an average annual capital reinvestment for this capital intensive. Sometimes it may be the same as depreciation. Sometimes it may be higher or lower.
And that's
do you ever look at how old the equipment is, right? Is that reasonable that you'd be accumulating that capital for a piece of equipment you bought 6 months ago?
Another good example in the capital assets is leaseholds. So let's say you have a
Mm.
10-year, 15-year lease and the company just spent 200, 300,000, whatever it is, some enormous amount of leaseholds. So you've got a challenge there because they're probably not going to have to incur it for another 10, 15 years. So should all that amortization be added back? Or do you say, well,
Yeah.
10, 15 years, you got to save up a little bit?
We also have a process question that came in a while ago. The client has more than one account, but the partner is only disclosing one of them. Are there rules to get them to get information on those other accounts? The spouse knew he has other accounts, but does not know which bank. So here you got I guess, a disclosure complaint by one of the spouses. How do you guys treat that?
In what? When you're when you're on a joint basis, when you're separate? When you're
Either. Well, I guess you get a court order for it or
Yeah,
direction.
we go back to council and say, you're gonna have to track this down for us, get it somehow.
This is a process question for council, not really for the experts. I agree. All right, let's take a look at our audience poll results here. Thank you so much, Shannon, for posting that. Most contested assumptions, gross up 21%, personal expenses 60%. See that quite often. Attribution of pre-tax corporate income 35%. We're talking about that today. Cash 32%, reliability of financial information 36%, and other 4. You'll put that in the Q&A and we'll find out what that was. How do these results reflect on you guys? What do you think? Is this pretty much what you're seeing all the time, or which one would you which one of your assumptions, I guess, get contested the most?
I would say if you put it all of the above, you would probably have the vast majority of people answering that. It's very hard to choose because the personal expenses, the gross up comes together with the personal expenses. It may come together with capital gains versus regular income, but that's a follow on. But the other ones, it depends on the situation, right? But as I said, my bane of existence is the reliability of financial information. That is an issue in so many cases.
Garbage in, garbage out. Jason, your thoughts?
Yeah, agreed. I think, look, all of these are very common, but personal expenses seems to be almost in almost every file. That is very common. And attribution of pre-tax corporate income is definitely an issue that's common whenever there's a business, which is why we're involved. And that's an area where I find there can be a lot of disputes between or among valuators. So, because it's very judgmental and you have to make sure you look at all the factors. And then unreported cash, it does come up, but it's very dependent on the type of business or type of industry, right? In some industries, it's much more common than others. But yeah, these are all very, very common issues.
So for an income assessment and the attribution, the pre-tax corporate income, how much are we moving the dial by here? Are we going to double the person's income potentially? Is it just 25%, or is it all over the map?
Could we use the it depends category?
Oh,
Shannon hasn't removed that yet, I hope. So
how successful, how profitable is the business? Because in some cases it can be very significant, and in others not so much.
All right. So, Melanie, what are some of the biggest issues you see in other experts' reports?
Yeah, and this would be similar. I think this is very similar to the valuation piece, is that and actually Jason hit on this on the valuation of the report side, is that often we'll get a report that say I relied on management for the personal expenses. And then I go, I'm not sure what to do with this. Do I have to go through all the general ledgers, get all the supporting documents? What do we do? Because there's not much to base it on. If the client just told the valuator, nope, there's no personal expenses, they did nothing, then you have to throw it back to the lawyer and say, I can't tell you whether this makes sense or doesn't make sense. I can look at the expenses and see how significant they are as to what maybe the potential risk is, but I really don't know until we do a lot of work.
Jason, thoughts?
Yeah, I would agree with all of that. I mean, personal expenses is a major issue in almost every file. And sometimes you have situations where sort of the non-business owner spouse basically has lived, the business has paid for all these expenses over the years. I know there's a lot of personal expenses. I know the business is paying a lot of personal expenses, and they're expecting that to be a huge adjustment in the income assessment. But it could be a situation where once we get into looking into the records, the books and the records, this is a business owner, an accountant that is very clean with their record keeping, and they track all of those expenses in the shareholder loan account. And then they clear out that shareholder loan account at the end of the year to income. So it's all on the up and up. There's nothing to add back there. So sometimes you have to deal with sort of educating your client on, what you're seeing in the documents and records.
Yeah, that's a good point. So understanding how the accounting records are, who prepares them, how they prepare them, what they do in the shareholder loan is really important. That's a great point, Jason.
So it looks like mischief on the top, but they're actually recording it properly and already attributing it to income.
Right.
Yeah. And they may attribute, it may be partly, it may be
Right.
all accounted for. Sometimes the accountant doesn't know everything. Even if they're correcting for a lot of it, it may not all be corrected for, but still.
Okay, another question for you, Jason, regarding the nature of the company and the capital reinvestment. What if the company has committed to or actually invested in certain one-time growth-related capital expenses? Can that be considered required for business purposes?
Yeah, this is a tough one. And I mean, on the surface, that's capital investment, right? So that's for business purposes. And I would tend to lean towards saying that, okay, it's been earmarked for business purposes, so it's not available for distribution. And it may be entirely truthful that those funds may not be available for distribution because they're being reinvested in growth or expansion. But sometimes what I hear from the other side is that, well, your client chose to reinvest in this business, not just for capital maintenance purposes, but for growth and expansion purposes, which he or she is going to benefit from down the road. Why should this business owner be allowed to do that and say it's not available for distribution for support purposes? When if they chose not to sort of embark on that growth strategy and just stay status quo, it would have been available for distribution. So it's a tough one.
Yeah. Melanie, thoughts?
Yeah, I totally agree. It's a very challenging one. And I think you can think of stock option exercise as a bit less of more of that kind of, do you control it or what, right? Because you can choose when you exercise an option. But so is that something that should it be included in someone's income now or later on? Similar to the growth, but if the growth, if this is needed and this is a rational business decision, then I would look a little bit behind the scenes and say, well, okay, can you lease or borrow, pay interest, and you can still pay support on it, right? Do you really need to finance something 100% with internally generated funds? You may want to, but is that really fair to the support recipient?
Yeah,
go ahead.
Well, I was just going to make a comment that what I hear so many times from business owners that I do income assessments for, once I start going through all these adjustments, personal expenses and the gross up, maybe related party wages and the gross up, attribution of pre-tax corporate income that hasn't been distributed, but it's theoretically available, but hasn't been distributed, we get this enormous income figure, which leads to high support payments, which the business owner says, I can't make those payments based on what I take out of the business. So it's very stressful and disconcerting for the business owner. I find that very common.
Yeah, it's just not workable. And then the business might fail too, right?
Right.
Yeah. All right, we've got one final topic, other income, but I want to go to one more question from Melanie. Aaron Franks and Adam Brewer talked about disclosure in their 2024 case law update. Some cases there if our audience members want to take a deeper dive. But the question is, I've seen CBVs provide long lists of disclosure requests, and sometimes disclosure requests go on for months. Why do CBVs come up with such long lists? And what if the documents on the list are either not available or relevant to the party who won't provide them? So Aaron Franks was talking about lawyers sending off letters and just stapling the CBV's disclosure requests and say, here's, produce this. So what's your response to that, Melanie?
Yeah, and you know, it's stressful. I'll say it's stressful for the evaluator because we're balancing our need to want to issue a report that is as accurate and reliable as possible with the cost. We know it costs a lot of money to do these disclosure requests, to go back and forth, maybe have to go to court to get the request. So, but we also don't want, we also think about going to court or being cross-examined or another expert looking at a report and saying, you didn't do enough work here. This is a wrong assumption. Why didn't you look at this document? So it's a very challenging. So part of the reasons it goes on for a long time is because parties aren't necessarily cooperating. So we come up with requests because we think about what we need to be able to issue an opinion on something, whether it's income, whether it's valuation, whatever, a value or whatever. But it gets to the point, as we sort of talked about in the last session, that sometimes people call the game. The fat lady sings and says, okay, we're done. We can't, there's just no way we're going to get any more. We've made all the efforts. My client has paid a small fortune to you, to me, to try to get disclosure, not doing it. So I want you to just move forward and assume this or assume that. And as I said last time, it's a little bit of a dangerous game because sometimes that's disadvantageous for the client, right? Because what kind of assumption are you actually going to make? So I'll go to the lawyer and say, what specific assumptions? And it may end up saying, if it's not clear cut what the assumption should be, maybe there's more than one assumption, and working with a scenario type of analysis.
It's a tough balancing act, right? Timing and delay and costs versus, you know, getting your report bulletproof, essentially. Jason, thoughts on disclosure?
Yeah, I agree with that. It's challenging. And sometimes when you get these very long disclosure request lists that can go on for pages and pages and pages, I find those situations are the situations where there's absolutely no trust. The trust is broken down and one spouse knows about stuff that's going on and wants to find out everything and dig into everything and make this a living nightmare for the other person. And when I see these long disclosure requests, like now it's a matter of going through the disclosure request and saying, is this reasonable? Is this really required? Is this even available? Because maybe it's not available and it's going to cost a lot and take a lot of time to actually put together to produce. So it's not an easy topic. I mean, obviously disclosure is required, but it needs to be relevant.
Yeah,
Right.
that's a good point. I'll just add one more thing to that, is that sometimes the lawyers will ask, well, Melanie, can you review the other experts' request list? And of course, Jason's are always reasonable, so it's not Jason,
Yeah.
but, and comment on it. And that's very challenging because usually experts are going to be deferred to when they make a request. Doesn't mean they shouldn't support it, but it's very hard for me to say, no, you shouldn't ask for that. And sometimes I look at them, I say, yeah, that's not an unreasonable request.
Yeah.
So, but I agree with Jason about it's often when the trust is broken down, but sometimes people use the disclosure issue, try to use the disclosure issue as a bit of a stick and try to, which is not reasonable. Sometimes it works very well, but it's can be
a litigation tactic as well.
Yeah, for sure.
So I think that's where counsel needs to step in and say, no, this is not reasonable, or we're going to review this with the case management judge and get the court's opinion before we produce another 12 banker boxes of historical data. That's what I would do if I thought it was pushing the envelope a little bit too far. Okay,
and
let's go.
If I'm ever putting a disclosure request together, I really need to have a reason why. Because I know if I get asked, why are you asking for this? You don't need that. I need to be able to respond. It needs to be reasonable and it needs to be required. Yeah.
All right. That's fantastic insight. Thank you. Let's go to our final topic of this afternoon, and thank you for the back-to-back doubleheader sessions. This has been super informative. Other income issues, sort of a catch-all here. What do you guys want to cover off? What do you think, Melanie? You want to start us?
Other income issue. I guess we've covered a lot, but one thing we didn't discuss in any detail was the issue of various sources of income. So as Jason said, from an income analysis point of view, you're looking at the employment income equivalent. So when you get these other sources of income, whether it's capital gains, whether it's dividends, whether it's money that regular payments from a trust, regular payments from parents, how do you equate that to employment issues? So watching for other sources of income.
Yeah, Jason, thoughts?
Yeah, on the other sources of income. I mean, there could be other sources of income that are not taxed, like capital dividends. They need to be included and grossed up. There could be other sources of income like dividends, which are taxed at more favorable rates, or capital gains taxed at more favorable rates than employment income. So they need to be adjusted and grossed up. Yeah, that is important. So looking at the different sources of income, I think also when you're talking about income assessments and looking at a particular year or a number of years, I think you also have to be mindful when you're doing those of, are you calculating the income for support for that year, like a retroactive payment? Or what you're trying to figure out is, what is the prospect of income, the potential ongoing average annual income that we should use for prospective support purposes. And that distinction, really, retroactive, I mean, the income that you earned in the year is the income you earned in the year. So there could be a one-time sort of a sale and disposition and capital gain. Well, you earn that income in that year. So that should be included in your income for retroactive support purposes. But when you're talking about prospective going forward, you're not going to sell that building every year. You're not going to earn that capital gain every year. So it should be adjusted out for prospective support purposes.
Yeah.
What about
sorry,
go ahead, Melanie. I was just going to
Just
ask
say-
about non-recurring income.
Yeah, non-recurring.
Yes.
And that's a good, well, it could be non-recurring loss, I suppose, too. But
Yeah.
that's an excellent point, because I find a lot of clients don't understand that. So they'll think, yeah, I may had this good year, but that's never going to happen again. But if it's within the support period, too bad, so sad. Maybe going forward, we normalize that out, but you're kind of stuck with it regardless of whether it's non-recurring or not.
Yeah.
2 more quick points and we're going to let you go. Thank you again. This next point could be an hour, but we've got to get it down to 30 seconds or 1 minute. Family trusts. Wow. Who wants to take a crack at that wasp nest? Jason?
Yeah, look, that's difficult. And from an income perspective or a valuation perspective, I mean, you want to be aware if and when there's family trust, and you want to get sort of the background information about that trust. You want to get the trust agreement. You want to have an understanding of who the executor or executors are, or who the beneficiaries are, what type of trust it is. Is it discretionary? What's the historical pattern of payments or dividends to the trust, and then from the trust out to the parties or the corporations? You want to understand that, but it's not an automatic inclusion.
Right.
And it could oftentimes come down to a legal issue where you might provide different scenarios.
Yeah, really. A really important issue on the trust is who effectively controls it.
Yeah.
Just like with, and also intentions, right? Because sometimes you set up a trust for the kids, but the intention is to sell the business, income split, but basically steal back the money from the kids, so they never get it. So intentions and control are really important.
Pretty good. That was almost a minute. Last one, double counting. What do we want to be thinking about for double counting?
Double dipping, you kind of mentioned that, double counting, whatever you call it. It's not a black and white issue. But it's something you need to consider. And it gets, I find, probably Jason has had this before, where very messy issues where we're doing income analysis before separation. Then there's some issues after separation. And then how do we get rid of non-recurring and stuff that's already in the valuation? So it's really, really hard to clarify, but this often is results in different scenarios, I find. If the court finds that this double counting isn't appropriate, here you go. If it finds it is, here you go.
Jason, thoughts?
Yeah, I agree with that on the scenarios, because here we're entering into territory where we're sort of blending or crossing over the valuation issues, which is the division equalization of property, and the income issue, which is an ongoing thing. And I guess the crux is, well, I've included that asset value in my assets, and I've already paid the other party for half of that. Why should I also include income that was generated from that asset in my income? And now I'm getting screwed both ways. That's where it comes up.
You're getting counted twice.
Yeah.
Great analysis, Jason, Melanie, fantastic. And I see Shannon is back, which means I think we're close to our time. Welcome back, Shannon.
Thank you. And thanks again, Melanie and Jason, for sharing your wealth of knowledge. Your presentations are always so informative. So thank you so much. And thank you to all of our audience members for tuning in.
All right, so go grab a coffee
Right.
or take a health break. We'll see everybody back here at 4:30. Jason and Melanie, fantastic as always. Thank you so much for your time today.
Thank you, Melanie, Russ, and Shannon. Bye-bye.
Thanks so much. Take care.